Welcome to the Rebel Income Coaching Session 9. We're going to begin talking about trade management in the last couple of sessions here. Equally important to being able to identify an opportunity to place a trade using the principles that we've discussed of the Rebel Income System is the ability to determine how much of your trading capital you should allocate to a given trade. Also to establish a plan for how you intend to manage the trade once it's been placed, and how to keep track of the results of your trades. In this session, we're going to talk about all three of these elements. We're also going to talk about some of the different order types that you can use to place your trades. All right, the first principle that we need to talk about is called position sizing. Position sizing is designed to help you make sure that whatever risk you accept in a trade, your actual exposure to loss is as small as possible. In simplest terms, it makes sense that using only a small portion of the trading capital you have for any one trade makes it easy to make sure you only lose a small amount in any losing trade. The challenge of taking such a straightforward approach for most investors is that small capital allocations also translate to smaller profits per trade, along with the benefit of limited losses. That's part of the reason that it becomes harder for most traders, especially those who are new to options or to being an option seller as we are in the Rebel Income System, to be disciplined in applying this mentality correctly. In the Rebel Income System, the first and most important rule or recommendation about position sizing is to make sure that your total exposure in any single position you take is no more than 3 to 5% of your total account size during bull markets or periods of macroeconomic growth. When I say macroeconomic growth, I'm talking about the economy in the broadest terms. We also prefer to shorten that exposure even more, shrink it, but move it below that 3% level when market conditions become more uncertain or even turn bearish. That is a natural and proper way to try to continue to minimize that exposure to risk when you think that the market might become more bearish, but you still want to keep your money working for you. As of this recording in June of 2023, I'm actively working to limit my positions to no more than about 2 to 2.5% of my total account at any one time. So we've shortened that below that 3 to 5% threshold, and in some cases, some trades I'm even below 2%. Traders are sometimes tempted to expand these thresholds, to go beyond the 3 to 5% to try to make more money per trade. But remember that in doing so, you have to also be willing to accept more risk. That also means wider losses and wider drawdowns in stocks when they move against you. That makes thinking about your position in objective, rational terms more difficult, because emotion is an inevitable companion. It's something that we can't get away from anytime we put real money into an investment. And our part of our job as traders is to learn to minimize that emotion in order to be successful. Keeping your position sizing thresholds more conservative is really the best way to learn how to manage that emotion and to keep downturns in stocks that you've been assigned from the Rebel Income System in perspective when they happen. In the long term, you'll find that what you do to limit your exposure will be far more important than even the best fundamental, technical, or value-based analysis. So it's really hard to overstate how important position sizing is. And you'll see me write about it on a regular basis in the blog. and talk about it frequently whenever I have the opportunity. Okay, let's talk about how to calculate and determine what kind of allocations you should use. What would be considered a conservative approach to position sizing versus aggressive. We're going to make a few assumptions here. This is just for illustrative purposes, just to demonstrate a practical application of the position sizing principles that you will see me write about a lot and to talk about a lot in the Rebel Income system. So we're going to start with, we're going to assume that our total account size is $250,000. As I mentioned earlier, we want to try to limit our position sizes in any one trade to between 3 and 5%. So the conservative end of that range is going to be about 3%. You may decide that you may want to shorten that even more, as I'm doing right now, and that's okay. You may decide that you're willing to expand it a little bit more and be a little bit more aggressive. That is also your prerogative. What I want to do here is just to demonstrate how those calculations work. So if we think about this really quickly, we know then that if we can multiply 250,000 times 0.03, and that gives us a total size, a total allocation, I should say, of $7,500 per position. That means no matter what a stock's current price may be, the maximum number of the maximum amount of money that that you would want to allocate in order to place a trade in that stock to maintain this 3% threshold is $7,500. Now, to kind of give you an idea of the scope of this is the reason that I've also listed the total number of positions that this makes possible. This would be assuming a cash secured approach to put selling where you're not using any margin at all. The reason that I'm listing this, showing that it's possible to have up to 33 total positions, is not to suggest that you're going to have to figure out how to manage 33 potential trades all at the same time. Only to point out that when you have the ability to have that many potential positions, you have a lot of, you're able to maintain a lot more flexibility than if you're using larger position sizes. As I mentioned, there's a temptation, especially when people start working with options, and this is true whether you're focusing on buying options on a directional basis or whether you're being an option seller, as I prefer to be with the Rebel Income system. There's a real temptation to try to allocate as much money as you can to those trades and try to achieve the maximum gain possible. Try to see the biggest impact on your account in the shortest amount of time. I'm trying to encourage you to try to change that mentality and work on the idea of not only trying to bring in consistent income on a monthly basis with very short-term trades, but also to be willing to work on a very, very patient basis on those with these capital allocations. Now, if you do want to expand this out, you want to take a more aggressive approach. I did say that the maximum recommended threshold that we're recommending is between 3 and 5%. So 5% is the top range. That means that in our $250,000 account, multiply that by 0.05, and our total allocation per trade is $12,500. Now this is quite a bit different than the 7,500. This does mean that you may be able to not only sell more contracts on lower price stocks, but also possibly to work with higher price stocks than if you're working with more conservative position sizes. So what you may see, if you're depending on what your approach to position sizing may be, you may find that certain trades that you'll see me highlight on the Rebel Income blog may not be possible with the allocations that you're working with. Try to resist the temptation to expand your position size just to accommodate the trade. Try to think about this very, very carefully in terms of how much risk that may allow you to take. Again, to put this in perspective by in terms of scale, if you're allocating up to $12,500 per position, that means that you could have a total of 20 positions total at the same time without any margin trading accounts. The reason I'm pointing this out is not just to give you an idea of the scale or scope that your portfolio may be allowed to accommodate, but also to think about how quickly you may be able to, depending on your approach to position sizing, you may be able to continue trading, or you may find yourself restricted from trading because of capital restrictions and capital limitations. Right now, speaking for myself and the account that I manage for Rebel Income, I'm managing a little bit over 20 trades, 20 positions right now, which considering that I am trying to be intentionally very conservative, is extremely manageable and does not put any extra financial stress on my account. I still have money available, capital available in my account to be able to continue to trade with, which means that I can continue to keep my account working for me. If you use more aggressive, larger allocations, what you will do is restrict that ability, because you can have a smaller total number of positions at any given time. That means that there's a higher chance that you may find yourself in a position where you have to either simply pass on trades or decide whether or not you need to liquidate positions to free up capital before you're actually ready to. Maybe that would force you to realize and recognize some losses that you may not have to do if you're able to if you were to use more conservative position sizing principles. So depending on the amount of your capital you're allocating in any single one of these trades, you can either enable more flexibility and more continuous trading, no matter what the market may be doing at any given time, or you may find yourself restricting your ability to continue to trade. Which is why, which it really is one of the primary reasons that that we advocate very conservative position sizing. Now, there's also a question: a question that sometimes comes up? Is this an absolute? Are these numbers that you're going to allocate to individual positions in your trades, are they fixed? And the simple answer to that is no. There may be times when it is appropriate to adjust your position sizing allocations. For example, you may decide to increase your position size when the stock market is clearly bullish. And when I say clearly bullish, I don't just mean that it's going up today or has been going up for the last week or even the last month. I'm saying that you can see that there's a clear upward trend that has extended at least 3 to 5 months, along with broad economic conditions showing healthy growth in the economy as well. Even in these cases, my recommendation is to continue to limit your maximum position size to no more than 5% in these cases. Again, considering that put selling tends to provide the most ideal results, when stocks are going up, there's a very powerful temptation in these conditions to expand and adjust your position size, allow them to go beyond this 3 to 5% threshold. If you choose to do that, just keep in mind that you are actively taking a more aggressive approach. You're going to limit your financial flexibility more than if you're taking a more conservative approach. That also means, remember that even if the broad market is generally going up, individual stocks can always be more volatile than the broad market is. That means that any combination, any event or combination of events can force a stock's direction to go up or down, no matter what the broader market's general direction may be. And so when you decide to allow these larger allocation sizes, you are tacitly accepting more risk in those positions. On the flip side, my preference is, well, excuse me, on the flip side is the question of when to decrease position size. And again, clearly you can tell that I prefer to take a very conservative approach to position sizing. There are some clear indications, some times where it should be very clear that decreasing your position size is the smarter thing to do. The first is if you can see that the stock market is clearly overextended and showing signs of increasing volatility. If you read my blog, you will see that I try to be as clear as I can about when I think those conditions may be. If you attend the Rebel Income webinar, I will try to be as clear as I can about when I think those conditions may exist. And you will see me make my own accommodations and adjustments to my position sizes in those cases. The other reason for decreasing your position size is if the stock market is clearly bearish. And what I mean by that is that if you can see instead of a broad market that is clearly going up on a continuous basis, that it is clearly going down. You can see a downward trend that has extended at least 3 to 5 months or longer, along with broad economic conditions that are clearly contracting. You see things like higher inflation, increasing interest rates, rising consumer prices, those kinds of things that are starting to elevate to extended levels and forcing a lot of pressure on things like unemployment. Where if unemployment is rising, that means that there are fewer jobs that will impact household incomes and force all of these other indications to also go lower. Excuse me. Remember always that smaller position sizes are more conservative. And this is true no matter whether we're talking about bullish or bearish market conditions. I believe that you will find greater long-term success in the investments that you make by applying consistently conservative position sizing principles rather than looking for opportunities to regularly or consistently increase your allocations. By going more aggressive, you'll generally expose yourself to more risk and increase the chances of seeing significant drawdowns in your account that you may not be able to accept or be able to manage the way that you should. The other part of this and the other reason for recommending that you should follow these smaller position sizing principles is simply that all trends are finite. All upward trends find a top and eventually they will go back down. All downward trends eventually find a bottom and will begin to go back up again. And because of that, It isn't a given that those trends happen with the broad market. The stocks have their own ebb and flow, and sometimes broader market conditions can have an impact on that, and at other times the other times the stocks will move completely independent of their of the overall market. Just a moment. My apologies. All right, so that's talking about when to adjust your position size. Just try to keep in mind that more conservative rules will generally work better than more aggressive ones. The other thing that's important about being able to track your trades and consider the success and failure of individual positions as well as progress of your account on a long-term basis is keeping a good track record, keeping a trading journal. I publish my my trading journal on the Rebel Income track record. Everybody that is subscribed to Rebel Income has access to it, and you can see every single trade that I make and what the impact is on my account over time. This is useful not only in trying to see how successful you are, but also to do things like evaluate the number of winning versus losing trades. That's a term that I like to call success rates. Consider how long you are typically in a given trade, and to evaluate your position sizing rules that you're following at the time against the overall account, and trying to see if adjustments are needed to your plan and to your system. Excuse me. Let me back up here just a minute. I want to take a moment and show you. Here is the live version of my track record. As I mentioned, I keep this updated with every trade that I post, and and everybody can see this. It updates live on the Rebel Income blog as I place each trade. Just to give you an idea of how my position sizing principles have evolved over time, I'm going to show you where I started. This we started the Rebel Income blog almost a little 9 years ago, and as you can see, we started with an account of about $100,000. Just consider this very first put sale on Dish Network. This had a strike price of $57.50, and I sold 3 contracts. Now, let's consider how large that is. We'll multiply 5750. If I sold 3 contracts, that means that I sold the potential obligation of buying 300 shares on this stock, which means that I was willing to accept a potential obligation of $17,250. On a $100,000 account, then that's more than 17% of that account. Now, this is a trade that expired. I was not assigned, and my money came back to me, and I was able to go and place my next trade, which is useful, and that's good. But it was also a very, very different from the position sizing principles that you're hearing me talk about and espouse now. Now, as time went on, I actively began to apply more conservative position sizing. Let's consider some more examples here. Let me go down a little bit more. Just a moment. Okay. Beginning in 2016, the market began to become more uncertain. Economic conditions were a little bit more volatile, and as a result, I began to decrease the size of my respective trades, and this really became something I began putting a lot more focus on in 2017. We can see, for example, let's see. Here's a put sell on GameStop with a $23 strike price. And it's still about 14,000, excuse me. Let me extend this out a little bit more. Here we go. Okay, a little bit later in 2017. Let's go with this one, SYF. This is a put sale in June of 2017. $29 strike price. I sold 3 contracts. Remember, I started with up to 17% was the total allocation that I was working with. With SYF, I only sold 3 contracts on this $29 stock. So $29 times 300 is $8,700. Now my account had grown by this point to a little over $200,000. Now that sounds really attractive, but here's what that meant for my position sizing. I was now down from 17 to 4%. So I was within this 3 to 5% threshold that I was talking about. Since then, I've become even more conservative. I've purposely begun to try to apply even more conservative position sizing in the period since then. Let me scroll down a little bit more. And let's look at some of these trades in 2019, excuse me, 2018, a lot later part of the year. Here's the put sale on Goodyear Tire at $20.50, 3 contracts. Again, 300 shares. Total allocation of $6,150. Divide that by 231,901, which was the account size at that point. And now that is below the 3% threshold, 2.65% at that point. Here's another one in 2019, the latter part of that year, on BWA, Borg Warner. This is a stock I've used quite a bit. $30 strike price at the time. I only sold 2 contracts, which means I had a total potential obligation of $6,000. And again, I'm a little bit below 2.5%. So I have purposely tried to become even more conservative as time has gone on. 2018, 2019, the stock market was clearly bullish, moving very strong. But the longer that bullish market and trend extended, the more conservative I became. And the more purposeful I became in trying to minimize the potential risks that I could see building if the market were to suddenly reverse very strongly. (2020) was a perfect example of that sudden reversal that I'm talking about. And this again prompted me to try to be very conservative with my position sizes. Here we have PSX, Phillips Oil Company. I sold one contract at $70, so 7,000 potential obligation against a $259,000 balance. Still, again, 2.69. So consistently trying to stay below that 2.5%. Let me scroll further down here and let me show you the allocations that I'm actively trying to work with now. With my account now having grown to about $276,000, my latest put sale on Suncor Energy, $29.50. I sold only 2 contracts. Oops, which means $5,900. $29.50 times 200 share potential obligation, $5,900. Divide that by 276, 146. And now I'm pushing closer to 2%. I've been actively trying to keep these allocations smaller than normal. With a recent put sale on WFC at 39, I only sold 1 contract. And in that case, 100 shares would have meant a $3,900 position size against that $275,942 account size. That was 1.5%. So I'm actively working to try to keep these allocations very small so that they can be more manageable for me as I think the market conditions warrant them. I may consider expanding these again if the market market turns clearly bullish, but even then I'm going to continue to be very conservative and try to stay probably within the 3 to 4% boundary, and try to stay actually as far away from 5% as I can, because I want to try to be conservative and make these trades more not only more conservative but easier to manage as I continue to manage my portfolio, manage my account. Remember that Rebel Income is not necessarily about trying to place a winning trade every time, but about trying to generate practical income on these trades while setting up attractive opportunities to own good companies at fair prices. That means that in many cases, I am going to accept assignment, and I'm going to take in shares of these stocks that I need to be able to manage effectively. And like I said, right now I'm managing about a total of 20 positions. It's very difficult to continue to trade if those 20, 25 potential positions, whatever your number may be, take up the entire account. And so making sure that you're being more conservative allows you the flexibility to continue to place trades over time. Okay, Let's talk about some of the different kinds of order types that are available now. The reason I want to take some time here and talk about this is because, especially if you are a new trader and certainly new to options, some of the principles about being an option seller as opposed to an option buyer may be a little bit foreign, especially the logistics and mechanics of placing these trades with your broker. The language of these order types and these processes within your brokerage accounts may sound a little bit foreign. So first of all, let's talk about opening a trade, placing a brand new trade with your broker. This is called opening a trade. Now, if you're going to buy an option or buy a stock outright, then those trades are the terminology for those orders when you place them with your broker is buy to open. Since we are taking the position of being an option seller, so we are selling first instead of buying, we always are selling to open. So it's always making sure sell to open rather than buy to open. In the same vein, most people, when they think about closing a position, selling the stock back to the market, or selling an option back to the market, but book a profit or to limit a loss, they will typically be selling to close. Being the option seller and starting the trade by selling to open means that in order to close the trade before expiration, we have to buy to close. Now, you've heard me say that I generally wait through expiration, and if the stock is assigned to me, I accept that assignment. That is not an order type, that's just the mechanics of those trades working themselves through. But from time to time, and depending on the variation of the variation you may decide to apply to some of the trades you see me write about, you may choose, rather than accepting an assignment, to close out the put sale before expiration. If you do, then you are always going to buy to close. That sounds counterintuitive, but remember that on the initiation of the trade, you are selling to open. So you're always doing the opposite opposite side of the transaction when you close it. If you sell to open, you're buying to close. If you buy to open, you're selling to close. There's also something that you need to think about, which is the difference between a market order and a limit order. There is, again, these types apply no matter whether you are selling to open, buying to open, buying to close, or selling to close. You will always have an option to select a market or a limit order. Market orders are very, very straightforward. They simply mean that you're telling your broker, I want this trade to happen as quickly as possible, and I'm willing to accept whatever the market will give me to do that. If I'm selling to open, then I'm saying that I want whatever price the market is going to give me for the put option that I'm willing to sell. If I'm buying to close, it's the same thing. I'm willing to pay whatever price the market is willing to make available to me to close that trade. What that means is that you're surrendering control of those prices to the broader market. That's not always a bad thing. If being able to move quickly is of paramount importance to you at the time, then there is absolutely nothing wrong with market orders. And in most cases, they will work out okay. Limit orders, however, give you a little bit more control. With a limit order, you have the ability to specify the price that you are willing to work with. Specifically, limit orders mean that you are telling the market the price that you are willing to accept either on the buy or the sell side, or better. It is always this price or better. Here's what this means. If I am selling a put option, well, let's say that that it has a current bid price of $1. I may choose to put in a bid price of $1.05, depending on what it looks like the activity in that option may have been. What I would be saying in that case is that I am willing to sell this option contract for $1.05 per share or more. And the only orders I will accept will be for anything that comes in at 105 or better. That means if there are any open offers to buy that option below 105, my order will not be filled. The broker will not complete that trade for me. This is, again, one of the differences between market orders and limit orders that becomes important. If your preference is to be able to get in as quickly as possible, then the market order is going to allow you to do that. With the same trade, though, if your current bid price is $1 and you put in a market order, you may see, depending on how the market moves, you may end up getting a better price or a worse price than the actual bid. As much as possible, I like to try to keep some semblance of control in the orders that I place. They are subject to market conditions. As I mentioned, the limit order may not be filled depending on the way that the market is moving at any given time. But my preference, as much as possible, is to keep my my orders on a limit basis, and try to work with reasonable pricing. If in my example I am seeing a $1 bid price and that looks like a reasonable price the way the market is going right now, and it provides sufficient premium and return on the capital that I'm allocating to that trade, very often my limit order will be at that current bid price. If I set that limit price for $1, it doesn't mean that $1 is the price I will get. It simply means I want $1 or better. Sometimes those orders come in a little bit more than that limit price, and that's great. And if you get your limit order, then that's okay too. Where these really become powerful in many cases is on the buy to close side. A lot of the people in our group like to take a little bit different approach with their put selling trades than I do. Instead of waiting to expiration, if the stock is moving favorably for them, they will try to close out that potential obligation, and they will set a limit order at a price they're willing to take. Let's say in the example that I've given you, if I originally sold a put option and I brought in $1 on that initial sale, a couple of days before expiration, if the stock has moved strongly enough, then it's possible that option may have a current asking price of 20 cents, which would mean that if I were to buy it back at 20 cents, I may go ahead and, I would be able to hang on to 80 cents of that $1 premium that I brought in, and it would remove the potential obligation associated with that put sale if the stock were to suddenly pick up a lot of bearish momentum. If I want to try to really kind of let the market come to me, then I can use a limit order. And maybe instead of 20 cents, I might set that at 15 cents and therefore secure an even better price. In that case, the language that I'm using is that I'm willing to buy this option back from the market at a price of 15 cents or better. And since this would be a buy to close, and it is a buy transaction rather than a selling transaction, that means that the price I'm looking for is 15 cents or lower. This is where the advantage of these limit orders is they allow you to shift the dynamic of market conditions that you want in your favor. It doesn't mean the market will move the way that you want, but it does mean that you're saying I'm only willing to have this order filled if the market is willing to move with me. And in many cases, if you're judicious and you apply this principle correctly, you'll see favorable price movements that that work out in your favor. Let me show you. Let me talk a little bit about this. Let's go over an actual example. I've listed a put option chain for Wells Fargo. WFC is the stock here, and you can see a couple of different expirations. I've got one set of options that expire in 2 weeks and another that expires in 21 days. The way to think about what kind of pricing may be appropriate here, you can go ahead and simply choose to accept whatever pricing is being listed for you, and there's nothing wrong with that. That is entirely your choice and your prerogative. But let's take a look at this. Let's look at the stock's last trading price was 42.18. That means that the at the money contract is 42. This is also an out of the money put. The last trading price on this option with a 2-week expiration is 74 cents. So this is 14 days, 74 cents. Now, if I am thinking about placing this as a new trade, that means that I need to pay attention to the bid, which means that I've got a 76-cent bid price on this right now, a little bit above the last trading price. Well, if I want to secure the best possible pricing on this, then I may go ahead and say, put in a limit order that says I want 76 or better. Or maybe I go somewhere in between 76 and this 82-cent asking price, and maybe I put in 79 cents if I'm willing to wait and see if the market will come to me. If seeing an immediate fulfillment on my trade is less important than getting the price that I prefer, then sometimes you can use the range in between the bid and ask to set the limit price that you want, whether you're selling to open or buying to close. If I go down here to the other option chain, we can see a similar kind of phenomenon going on here. We have 21 days in this case. Still, the $42 put is the at the money contract. The next available is 43, which is a little bit deeper in the money than the 42.50, which is available for 1 week. That's interesting. But look at the last trading price on the $42 put. It's 85 cents. With a high at 90, low at 83, and a current bid price of 89 cents, and a current ask at 95. So if I wanted to place this put sale, I could put in a bid price certainly at 89 cents, very possibly a little bit higher. Maybe I could go to 90, 92 cents and bring in a little bit more premium on that trade. If I were trying to buy to close, the fact that the asking price is 95 cents, while the last trading price is 85 cents, means that if I were trying to close out a put sale on this trade right now for whatever reason, instead of simply taking and accepting the current asking price, I could probably put in a buy limit to close order for 85 or 90 cents and would in all likelihood see that order fulfilled. So there's a few different ways that you can try to look at the difference between the bid and the ask prices when you're deciding what kind of a limit price you want to use. There's not a single best way to approach this or to apply this. In many cases, this is a matter of experimentation and trying to see what you find works best for you and what doesn't. You may decide that trying to wait for the market to come to you is a little bit nerve-wracking and harder to do, and that's okay. There is nothing that says that this is what you have to do. This is just an example. Okay. The other thing that we want to talk about here is the element of thinking about downside protection. You've seen me talk about taking assignments from put sales and potentially watching those stocks extend into deep downward trends. I don't shy away from those because these are companies that I like anyway. I'm willing to own them for long periods of time, bring in the dividends that they pay, and wait for the stock to come back to my original price. As long as I think the fundamentals are still solid, the value proposition is still attractive, that is an approach that has been successful for me. Some traders prefer to think about it in different terms, and that's fine. One of the things you can always do if you see a stock moving strongly against you before expiration is you can always buy the put option back. Remember, you're always going to buy to close in those cases. You may have to, depending on how far the stock has moved away from the strike price you sold, you may find yourself having to absorb a loss in order to close out that put sale and eliminate that potential obligation. The flip side and the advantage for people who are trying to minimize loss as much as possible per trade and per position is that it eliminates the potential obligation and also removes the risk of being assigned a stock and then having to sit and watch it potentially run through a long downward trend, which is a reality that I actively accept by taking put sale assignments. So depending on what your preference is, this is an alternative that is more than okay. Another method is to apply what is generally called protective puts. You can think about protective puts as buying insurance against the stocks that you purchase or that you are assigned from put sale assignments. The simple way to apply this is to buy a put option at or below your purchase price. If I'm assigned a stock at $40, I could then buy a put option for a couple of months out at that same $40 strike price. The idea is that if the stock does drop below $40, the profit from that put option should offset at least to an extent the loss in the stock. It may not be dollar for dollar, but this can be a good way to minimize some of those losses. One of the elements to keep in mind is called proportionality. If you're going to apply this method, think about the total number of shares that you have been assigned. If I've been assigned 200 shares from a put sale, for example, and I want to buy protective puts, if I want the protective put to be applied as fully as possible to that position that I've taken on, then I should buy 2 put options at that $40 strike price I mentioned in this example. If I only buy 100, then the size of the move if the stock goes down, the size of the move in that put option is only going only going to really impact about 100 shares of that total position that I have, and not have the effect of blunting that potential loss the way that I intended. This is why I said that this is very, very much like buying insurance. You can think about protective puts as a kind of a cost of doing business. In most cases, you may not see any profit at all from these put options. It is not about trying to turn a loser into a winner as much as it is if you do see the stock drop significantly in price, trying to minimize the size of that loss as much as possible. If the stock goes up, the put option will simply expire worthless, and you would have to be willing to accept that as the cost of doing business, or buy it back at a much smaller price than what you paid for it. So protective puts is a way to simply try to minimize that loss, provide some downside protection as much as possible. Don't expect to see those completely offset declines in stocks when they go down. The other method that you can apply is to use a stop loss. Some of the people in our group, if they take a put sale, take an assignment from a put sale, they'll recognize that the stock may go lower, and they may need to be willing to allow that to happen to an extent. But they will think about how far that could go before it becomes a little more painful than what they would like to be forced to absorb. And so in these cases, setting a stop loss perhaps 15 to 25% below your purchase price following assignment might make sense. You can also apply a combination of protective puts and stop losses on these positions as well, if you choose to. The other thing to remember about protective puts is to think about these as a cost rather than as a profit generator. Stop losses are going to be something that are going to increase the number of losing trades that you have from put sale assignments. You'll recognize more losses with stop losses than you will if you do what I do, which is to not apply a stop loss and simply wait for the stock to come back to the price that I bought it at, as long as the fundamentals and the value proposition are in place. Taking this longer term view of these put sales and understanding that I'm using these put sales as an opportunity to buy these stocks that I like and may choose to hold for a year or more is something that has worked well in my account to this point, and that has proven its value over time as an investing method by many of the most successful value investors of all time. But not everybody has is willing to wait and be that patient. And so these strategies give you some alternatives to think about and to possibly experiment with as you're trying to determine what is the approach that works best for you. It's also a question of when to call a loser a loser. And the simple fact is that even though I am willing to sit in stocks for an extended period of time, there have been some cases where I have been forced to recognize a loss because I just recognized that the opportunity in that stock of seeing it come back to my purchase price was probably just not there. This is a situation that has fortunately been rare. But if you see fundamentals degrading in a significant way, not simply in terms of numbers, but if you see changes in management or other indications that indicate that the business model is just not working and is not likely to change, either in the near term or in the long term, then it may simply be time to go ahead and call a loser and move on to something else. As I mentioned, that's been a rare exception in the Rebel Income system so far, but it is something that may come up, and it is something that you need to be willing to think about on any of these stocks when they start to drop into these downward trends. All right. Appreciate your time and your attention. Let's talk about session 10. We're going to expand our discussion of trade management. We're going to talk about some really important principles. I've alluded to a few of them in some of the other sessions up to this point. We're going to talk about some things like success rates. In other words, evaluating the number of winning trades versus losing trades over time. Talk about trading frequency and what that means in terms of trying to calculate and estimate your long-term results from the income you generate from put sales. We'll talk about the difference between taking an active approach to put selling and income generation versus versus the approach that you see me write about and that you will see me follow in the Rebel Income blog, which is something that I consider to be a little bit more passive. I'll also talk about some advanced position sizing principles and thinking about applying covered calls in a downward trend. This is another interesting alternative that you can consider using in stocks that are in extended downward trends that we don't have time for in this webinar, or in this session, excuse me, but we will talk about in session 10. Thank you for your time. Look forward to talking to you next time. Thanks.